I'm Charlotte McLeod with the Investing News Network, and here today with me is Mike Larson, Senior Editor of the Safe Money Report at Weiss Ratings. Thank you so much for joining me in person today. Great to see you.
It is great to be back in person for these things, huh?
It is, yeah. Well, and we're here at the Rule Symposium down in Florida. I wondered, as a first question, if you could tell me about how you're feeling sentiment on the show floor. How does that seem?
Sure. I mean, it's great being here. You know, I've been to a couple of the conferences either in Vancouver or when they went virtual during COVID. And it's great to have the environment where it's live. You know, you're talking to people, you're getting to interact with the companies and the other presenters. I much prefer the face-to-face interaction, and it's great. You know, it's a new environment, it's a new location, and just getting to talk to people and sort of get their sentiment on gold, what's happening in the markets. It's a great environment. Everybody seems very happy.
Yeah, and what I've been saying to people is that the timing for this event seems quite perfect. We just had the Fed meeting yesterday. We got our 75 basis point rate hike, which I think people largely expected. The other thing that's going on, though, out of this Fed meeting is these recession questions. And I wondered if we could start there, because
Sure.
we had Powell yesterday telling us, oh no, we're not in a recession. Today we have those GDP numbers that indicate, you know, according to one definition at least, we are. So why is it so hard to make a statement on this?
Sure. Well, it's definitely not a boring market environment. Let's put it that way. You're right. There's a lot going on. Powell did largely, meet the market's expectations with the 75 basis point hike. He did throw in a little hint that maybe they might slow later, which the market tried to latch onto, gave us a little bit of a rally. And if you look at the interest rate futures market, you look at what it's pricing in, not just for the rest of this year, but next year, there is some increasing concern being priced into that the Fed's going to have to do a U-turn, that we're going to get into next year, the economy is going to be in recession, that's going to basically give Powell cover, and he's going to see what's going to happen to unemployment as a result, and he's going to backtrack. I mean, we've seen, if you look at the history of the Fed, how many times have they gone too far, either when it comes to easing or when it comes to hiking? So they're not very good at catching those turning points. So the market is increasingly looking at that and worried that Powell is going to do this again. You mentioned the whole recession thing. I think it's kind of silly. We're arguing if something has always been considered a recession and then you meet that definition, just change the definition. That doesn't make any sense to me. So we're either, in recession, very close to it, and it's essentially splitting hairs, right? Whether it happens as a result of these two negative quarters or whether it's because you see unemployment picking up later this year, you see retail spending slowing, all indications say, if we're not already, even if you want to ignore what the numbers are showing, we will probably meet those other broader things, those other broader characteristics, whether it's employment, spending, production, all that stuff, as we head into the back half of the year.
Right. I do think it's quite unfair to just change definitions when things like this are happening. So, but Powell yesterday was talking about the labor market strength as his reason for this is not a recession. I wanted to ask you what you're seeing there and if that makes sense as a statement.
If you look at what's happening with jobless claims filings, right, which is the first step before you see layoffs begin to climb sharply and before you see new job creation fall, you're seeing claims filings go up. We actually are at about 8-month highs in terms of initial jobless claims filings. So you are starting to see some people get laid off. You are starting to see people filing for unemployment assistance. That's kind of the first step in this. I think what we're going to see, again, with labor being sort of a lagging indicator, if you're a company, you don't fire somebody right away. First you have slower sales, then you try and cut costs. You don't want to let your people go right off the bat, but eventually if your business doesn't turn up, you have to. So it's one of those things that sales start to fall first and then layoffs happen later. And I think it's just a lag issue. I think that there's a lot of things pointing to, hey, we're going to have a weaker labor market as we go later into this year and into early next year. It's just not fully showing up in the numbers, but even there, it is starting to show up in claims.
Right, and so lots of people talking about where the Fed goes from here, right? And we did get some indications yesterday of what they're thinking, but you're mentioning probably at some point we see this pivot. I don't know if you want to speculate on when that might happen. I think a better question might be what would prompt that.
Sure. I think the Fed is going to go further in this cycle or try and stick to their guns longer than they would have in any of the last couple of interest rate cycles. And that's simply because of the economic data, the inflation problem, not just from an economic standpoint, but from a political standpoint as well. They have to be seen that they're going to be doing something to make Main Street happier, to try and bring down inflation. So I think the Fed will go further than it might have in the past couple of cycles because the inflation numbers are so bad. But by early next year, I tend to agree with what the market is starting to price in. we're going to be having things like rising unemployment. We're going to be having more, big layoff announcements. We're going to be having the consumer. I mean, confidence has already fallen sharply. We're going to start to see consumer spending slow down. And even if you look at Walmart warning about earnings the other day, I mean, the Walmart customer is already having problems. You're going to see more announcements like that. So I think that the Fed will probably have to backtrack, pivot, whatever you want to call it, as we head into early next year.
Right, and let's talk about inflation as well, because I think every time we get a new report, we hope or think that maybe this is the top, which so far it has not really proven to be. So what do you see coming there?
I think inflation, because some of it is related to things that economics can't really control, whether it's what's happening in the natural gas and oil markets because of the European and Ukraine and Russian supply situation, whether it's because of some of the other supply issues, it's not as easy to fight this kind of inflation as it might have been in the past. But I do think as you see joblessness rise, as you see spending come down, the lagged effect of the rising dollar that we've had, all of that is going to work to take some of the steam out of inflation statistics heading into next year. It's just a question of how fast does that happen and how fast does Powell acknowledge it and sort of turn around in terms of his policy path. And I don't think he'll have the political cover or economic cover to do it until we get, again, probably into next year, early next year.
Right. So again, looking to yesterday after the meeting, the press conference, we saw major indexes get kind of a lift. Of course, they're still down year to date. And I know here at this symposium, there's a lot of talk about markets are going to crash, et cetera. What are your views there?
Sure. Again, I think that this cycle has a lot of similarities to what I saw in the late 90s and early 2000s, kind of that dot-com cycle. We had a lot of malinvestment driven by easy money, a lot of companies in sectors like EV and parts of the tech market that had no profits, had no plan to make any money, but were able to raise billions of dollars simply because there was so much money floating around out there. Those kinds of companies and those kinds of stocks are already getting hammered. They started losing value last year. You're starting to see some of those companies go belly up, and that's going to contribute to, I think, the recession that we're seeing. So to me, I see a lot of parallels there. Does that mean I think the Nasdaq's going to fall 80%? Probably not, but I do think you're going to have that part of the market is going to continue to be hurt pretty hard, and you're also starting to see that those companies, like the sickness that was in that sector, is starting to spread up to big tech and other parts of the economy and parts of the market, sort of the big cap companies. So I don't think this bear market, whatever you want to call it, is over. I think it's going to continue. The economy and the market is going to continue to struggle for the rest of this year. Once we get into next year, we see what the Fed's doing. Maybe we get rid of some of those companies that probably never should have been companies in the first place, and it cleans out some of that mess. Maybe we do better. But for me, I'm still advocating a defensive stance, what I call kind of a safe money approach to investing, dividends, stability, boring companies, even if you will. That's what has been doing very well relative to the riskier stuff, and I think it's going to continue to do so for the rest of this year and again heading into 2023.
Yeah, well, let's talk a little bit more about that, because I think you're right. People hear these recommendations and they're like, that's not interesting at all. That doesn't sound exciting. So, but this is the way to go.
Yeah, absolutely. Again, if you compare what we saw in the dot-com era, and that was these B2C, B2B, internet type companies, all the stuff that was hot and sexy back then, whatever did very well, and then a lot of them crashed. This time it was EVs, it was crypto-oriented things, many sort of parts of the market that were sort of emerging tech that were exciting. But what's happened? A lot of those companies have crashed and burned. And so what you're seeing is as money is lost in that sector, and as people realize this isn't the same risky, strong economic growth environment we had, they're rotating into your boring stuff, your dividend-paying companies, your stable companies who can still make money, generate revenue and earnings in a pre-recession or recessionary environment. And again, it might not be exciting, but even if you go back to the dot-com bust, in the year 2000, the tech sector lost 42% of its value and then kept losing value. That same year, utilities and REITs, real estate companies, were up about 20%. So you can see that money has to go somewhere, and the more defensive kind of things are doing well while other parts of the market are suffering.
Right, so you've got options. You might not like them, but they're there. And we've got to also relate this back to gold. Is gold part of that safety package for you?
Yeah, absolutely. I've been a big picture, long-term gold bull since the second half of 2018. Obviously, for a while that did very well. We went through this long sideways chop that we've had. And more recently, precious metals have been hurt by the rising dollar. But I think what's going to happen there, particularly that big headwind that we've had for gold and silver, is going to be taken away, because if the market starts to perceive, hey, the Fed is going to have to to backtrack soon, at the same time as some other countries are still going to have to get their rates up off the floor. That's going to take some of the wind out of the sails for the US dollar, and that's going to remove, again, that big headwind. So I think when you look at the need for safety, when you look at the concern for inflation, some of those other things that traditionally have been bullish for precious metals, and then you take away that one thing with the rising dollar that's been in the way, and you've got a pretty good recipe for gains. So I think, yeah, I remain a bull on precious metals, and I definitely have that stance for the rest of this year and well into next year as well.
Yeah, well, that answers one of my questions, because there are a lot of factors out there affecting gold, and I have been trying to track down what people think is the main thing standing in the way. In terms of price, are you of the view that it has much higher to go, or are you a more measured price increase?
I'm probably more measured, but I do think, again, I don't see any reason why gold can't take out that high that we've seen, that sort of low $2,000 an ounce US range that we were in for a while there. I think that those peaks are probably going to be eclipsed as we head into the part of the cycle where the dollar stops going up and probably reverses. We have the Fed backtracking on policy. We have more credit turmoil in the bond market. As we head into a higher default environment, recession environment, you're going to have turmoil there. So people are going to be looking for safe havens. All of that works into a bullish environment for gold. So again, I don't see any reason to I wouldn't be too worried about what's happened recently, because I think you can pretty much point to one factor, and that one factor, in my opinion, is likely going away.
Okay. This has been great. I wondered if, as we wrap up, you have any final thoughts that you think investors should know about today?
Sure. Again, I think that, regardless of whether we want to play word games or definition games, recession, no recession, that's really just getting caught up in sort of the nitty gritty. The big picture story is that we're in a tighter monetary environment. We're in an environment where the economy is in more trouble, and we're in an environment where the risk of financial accidents because of tighter money goes up. All of that is, again, a perfect reason why you want to play defense with your investments, whether that means dividend-paying, income-generating stocks in more defensive sectors and/or precious metals. Some combination of that makes all the sense in the world to me for the rest of this year and, again, into next year as well. Okay, well, thank you so much. It was great to have you here to talk about the markets. Thank you again. Awesome. Glad to do it. All right, and once again, I'm Charlotte McLeod with the Investing East Network, and this is Mike Larson.